You've been told whole life builds wealth, but the real cost is buried in fees, commissions, and years of slow growth. Today, I'll show you how it hurts your finances and what works better. You're juggling mortgages, tuition, bills, and kid-related expenses. You don't need fancy financial products. You need clarity, low-cost protection, and investment strategies that actually build wealth. Recently, I sat across from a couple investing in whole life because who doesn't want tax-free cash value? They thought they were making a smart move. But here's the bad news no one told them. Whole life charges 3 to 5 times more in premiums than term life with the same coverage. Add in management fees and agent commissions, and your money grows at a crawl, often just 1 to 2% annually. Now let's crunch the numbers. Imagine paying $400 a month into whole life. After fees, your cash value grows so slowly it might take 15 years before it breaks even with what you paid into it. Meanwhile, that money could have grown far more in a low-cost index fund or Roth IRA. Another issue, you can't easily access it. Borrowing means pledging your own money and paying more interest to do it. It's like depositing money into a vault, then taking it out with the fee. But the real kicker is the opportunity cost. Cash tied up in insurance premiums can't be used to pay down debt, invest, or build an emergency fund. So what do families need to do instead? The answer is simple and often overlooked. Term life insurance, affordable, straightforward protection. No fluff, no cash value. Just the death benefit during your working years. Looking for low-cost investments? Invest the difference in index funds, Roth IRAs, or a college savings plan. Simple rules, big impact. If it's a strong financial framework you need, emergency savings, debt repayment strategies, household budgeting, and smart asset protection is the way to go. Let me share a real-world example. A 35-year-old family paying $3,000 annually for a whole life policy decides to switch to term, costing $700 a year. That frees up $2,300 yearly, over $46,000 over 20 years. Invested wisely, that money has far greater growth potential than the cash value inside a policy. Another common misconception? I want lifetime coverage. If you're relatively young and responsible, you only need term coverage matching critical financial milestones, like child dependency or mortgage payoff. After that, life's engine is fueled by your investments, not insurance. Here's what I always tell families. Insurance is about protection, not investment. Investing is about growth. When you mix them, you end up with mediocre results in both. It's like expecting your umbrella to double as a parachute. You need 2 separate tools with separate purposes. One final thing. Whole life policies can create revenue for an agent, but they reduce your flexibility. Policies lapse, payouts change, and borrowers often don't realize how slow their money is growing until it's too late. So what's the best move? Step 1, assess your protection needs, kids, mortgage, liabilities, and get term life covering that. Step 2, use the premiums you save to invest in something that actually grows. Step 3, review your plan every year and stay informed, because financial neutrality doesn't help anyone. That's your strategy. Affordable protection, smart investments, and sober financial clarity, without the sales hype or hidden cost. If you're unsure what you've been sold or want help reallocating your premium dollars into something that builds, DM me cash value and I'll help get you clear. That's all for today's Fun Fact Friday. Tune in next week for more truths the schools didn't teach us. Don't forget to like, share, and comment on this video. And remember to manage your money, or money will manage you.